Hey everyone, happy Wednesday. Hope you're having a great week. So today I'm going to bring on Nee Lee. Nee is a friend of mine. He actually works for a hard money lending company called Certain Lending. And he's going to talk to you guys a little bit about, from the hard money lender's perspective, how these loans work. And then I'll talk to you guys about the investor side of, how I've structured deals and how, some of this works. So Nee, now that you're on, do you want to talk about yourself and Certain Lending and what you do and kind of your role in the hard money world?
So my name is Neely. I'm an investor myself. I've been investing, started in Seattle area 4 years ago. We started primarily doing flips and then slowly transitioned over to I care more about cash flow now, especially after having two young kids. And that's when I started doing more BRRRRs and out-of-state investing. Over the past 3 or 4 years, I've been around hard money a lot. I've borrowed from a couple dozen different hard money lenders. I've talked to over 100 others, just kind of nationwide. All of this was inspired by I had a flip where I paid about $280,000 worth of loan fees overall. And I kind of told myself I would never do that again. So I went on a quest to find better financing and cheaper financing. That's kind of why I'm in this business now is, I learned a lot from those many hours spent on research and talking to lenders and actually doing loans with lenders. Coming back to where we are as Certain Lending, we're a fintech company, VC backed. We want to change the financing industry for investors, right? And so we want to make it more transparent. Hard money is an industry that isn't really regulated as much as conventional. So there's a lot of things you don't see behind the scenes, even until closing. And we don't think that's the right way to approach it. So we want to make financing cheaper, faster, and easier. And we want to be a one-stop shop for investors. A lot of it is driven by just everything I've experienced as an investor, both on the flip and on the BRRRR side and all the out-of-state stuff.
Awesome. Great. So, one question that I get a lot from investors is how do you continue to buy rental properties without running out of money? And running out of money being the required down payment that it takes to get these loans, and then also, the renovations. For some people, if you're starting with a certain amount of money, that can be taken up in one property or you can spread it across several properties. So myself, I've actually, kind of dealt with this as well a couple years ago is, my husband and I realized that if we just kept using our own money and kept doing it the traditional way, which is putting 20 or 25% down for non-owner occupied properties, we were going to run out of money pretty quick. And so I learned this strategy about using hard money loans and kind of, I don't want to say manipulating the system, but basically working around it a little bit to again, not have to use all of our money, that would just get us a few properties. First and foremost, for those who've never heard, we're going to talk about what hard money lending is and kind of describe how that all works. We're also going to talk about when to use hard money and when not to use hard money. That's a really important thing is you kind of want to look at this as a tool and make sure that you're using the right tool for the right scenario. You don't want to get into a situation where, you're stuck in these hard money loan interest rates and terms and everything and, not having a value add play to get into that. So we'll talk about that. We also want to talk about the specific strategy that's really my favorite is how paying for hard money can actually save you money. It sounds a little backwards, right? To be paying these crazy interest rates or these crazy points and things like that, but that can actually save you money. And saving you money really means your hard-earned money that you're using to invest in rentals. The other thing is we want to talk about, why you shouldn't use hard money and then also how to find the right hard money lender. Anything to do with investment real estate, you're always wanting to work with the right people, in the right kind of case study or use, for your strategy. But we want to talk about the difference of that, specifically the difference between national lenders and local lenders. So we'll cover that. And then Nee's going to tell us about what he uses to pre-approve someone and how you get kind of quote unquote pre-approved for hard money lending. We're also going to cover some general rates and terms so that you guys can get an idea of kind of what to expect if you are using this strategy. As you're running your numbers and doing your analysis, you want to get an idea of what the points are, what the terms are, and then also, the interest rates, because you want to factor all of those into your deal. Financing expectations for different markets. There is a huge difference when you have a hard money loan for maybe $3, $4, $500,000 versus a hard money loan for 50. So we're going to cover the different terms and kind of set some expectations on it's not necessarily the same all across the board. So that's super important. And then specifically, probably what most people would find of value is to talk about the BRRRR strategy with hard money loans. And that's something that's often kind of confused or confusing because a lot of times we start with kind of the end in mind is, who are you going to use for the refinance? Is it going to be conventional? Is it going to be portfolio? Is it going to be commercial? Because that you want to focus on the end in mind to determine how to set up the hard money in the beginning. So we'll talk about that. All right, so first things first, what is hard money? So hard money is basically, it could be a person, it could be an entity. It's more of a descriptor for a type of loan that is kind of unconventional or untraditional. So typically we, as investors, we work with mortgage brokers and banks. And mortgage brokers and banks and bridge lenders and everything, they all have their set of requirements. And oftentimes that, means that the property has to be in a certain condition in order to get financing. So if an appraiser is involved on a, property that is in really bad condition, if there's any, kind of structural issues or health and safety issues, that's just not going to fly with a conventional lender. Maybe on a portfolio side if you have a really good banking relationship, but there's some kind of set standards that need to be applied on the condition side and things like that. So that's where everything else that doesn't fit into that category, that's where hard money lenders come in. And so, here I'm based in Seattle. We have some massive players on the hard money front. So we've got some big companies that have a lot of money to loan, and primarily in, these West Coast markets or, California, Arizona, and Washington. And so, so basically you have these big kind of entities and they are accompanied and pretty much all they do is either bridge loans or hard money loans. And so they have a set of criteria, standards, things like that, loan to values. But typically, I think the most important thing to know is that they are usually more willing to accept properties that are in worse condition or have issues that wouldn't otherwise qualify for conventional financing. And so, anyways, your only option as an investor is to either pay cash or get a hard money or private loan or borrow money from a friend or something like that. So that's kind of why hard money lending companies exist. Is they exist in order to kind of fulfill a need where investors, can't otherwise fill it. Now, when I say investors, I'm specifically saying that because typically hard money lending cannot be done on a owner-occupied property. So for anyone that's used to usury and those kind of laws, that's a consumer protection thing. And so for anyone that is interested in this strategy, I want to make it clear that we're talking about non-owner occupied investment properties. So anyone that, wants to buy even like a houses at auction to live in, or things like, a property, even a rental property that's in really bad condition and they want to live in one half the unit. I think there are a few companies out there that maybe have a consumer license to do kind of bridge loan type stuff for those. But specifically for this conversation, we are talking about non-owner occupied investment properties. So that's hard money. So hopefully that's kind of clear, how that works. So let's talk about when to use hard money and when not to. So when to use hard money, usually that's where you have a huge value add opportunity. So, just some examples of when I've used hard money. It's been either at the foreclosure auction where I was getting it at a discount. So the condition could be really good or it could be really bad. I mean, I've bought some houses that were built in the 2000s at the courthouse steps, doing that. And I got them at a discount. I mean, there was one where I bought for like $87,000, built in 2001. Didn't actually get around to doing any work on it, but bought it at auction, got the hard money loan. Bought it on a Friday, started the refinance on like Monday, Tuesday, sort of thing. So the spread there was just because of I knew that it would be appraised for much more because I bought it at a discount. The other option, I've used hard money on like huge value add duplexes or multifamily where the condition is so bad that even if I wanted to, you couldn't get financing on that, roofs caved in, mold, that kind of stuff. You want to make sure that when you're using hard money, you're either going to increase the value because you got it at such a discount and it's going to appraise for more, or you're putting something in to the on the condition side. So that kind of goes now to the next thing, is when not to use hard money. So for example, if you're buying a, say, B class or A class, or any kind of property where there's not really a value add play, if you get hard money to then have to refinance it, and it's going to be, refinanced at what you bought it for, then not only are you having refinance costs for your conventional lender, your commercial lender, but you're going to have to pay all those points and interest rate, the high interest rate for hard money. So anyway, so that's kind of, in my opinion, a bad use of hard money. All of this, we are tied to whatever the new appraised value would be. So you definitely want to make sure that, I think first and foremost, when you're looking at any property, is to pull comps of similar properties, because the appraiser, whoever's appraising it, is actually going to need comps also to support it. So even if you've added value on the condition side, but the comps aren't there, that's going to be really hard to, to use that new appraised value. So anyway, so don't use hard money if you don't see that the new appraised value is going to be higher, because you're just going to cost yourself a lot of money and it is not going to be good. Unless you're okay, like, I guess the only caveat to that would be if you're in a multiple offer situation and you really want the property, unless you want to be competitive and pay cash, and then you are okay if the appraisal comes back at, what you bought it for, and you're willing to, come up with the difference, then that is totally fine. But again, I just want to make sure that, people aren't getting too excited about this hard money stuff, and then, frustrated that they then have to do the refinance and bring in 20 or 25% down. Do you have anything to add there, on, when to use it, when not to?
My philosophy is, like, always try to go conventional if you can. Obviously, that's the cheapest cost. Where it presents a problem is that there's more risk involved when you're using conventional lender, closing risk, right? And things drag on, and sometimes things die at the end and they can't close. There's a lot of properties that don't qualify for conventional financing. Mm-hmm. There's a lot of investors that also don't qualify for conventional financing. That is essentially where hard money comes into play.
Well, and actually you bring up a really good point there too, is if somebody, if an investor is unable to qualify for a refinance, then they should have that in their business plan to sell the property as opposed to try to keep it. I think that I've actually seen that before, where an investor used hard money thinking, oh, no problem on the refinance, only to find out that that would not be an option for them. And so again, at that point you're forced to sell. And if you didn't buy it right, then you're forced to sell and potentially take a loss. So you want to be very, very careful. Yeah.
And jumping to that topic, this is why I tell people, if you're doing kind of a BRRRR strategy, you kind of start backwards.
Yes.
Right? You make sure that you are qualified on the refinance first before you take on the deal, before you get hard money, because the last thing you want to do is be stuck in a hard money loan with no way out.
Absolutely. Absolutely. And as we're talking here, definitely feel free to ask questions. I'm kind of, if you see me looking to the side, I am watching my laptop right here for any questions that come in. So, Nee, let's talk about, why you shouldn't use, or why an investor shouldn't use just any hard money lender. I think you've talked about, or you kind of touched on that, how you've talked to all these different hard money lenders. But what's the difference between, maybe an online kind of lender that people can go in and fill that out, that's like a nation wide lender, versus, smaller regional ones? Like what do you see as the difference?
I see, well, first off, there's a lot of scammy lenders, right? I think the money lending is where the new Nigerian princes are kind of targeting, right?
Yeah.
So just be careful if you see something, a lender advertising on Facebook or Craigslist or something, and if they have a Gmail account versus an actual, domain, email address, and all this other stuff. So I always do your research, for one, on the lender. The biggest issue I've had with lenders is their ability to close. And I think that's first and foremost. Any lender, no matter what you offer, you have to be able to close. You have to be able to close on time, and you have to be able to close at the terms that you originally stated, right? There's a lot of lenders that do a bait and switch. They hide things up front, and you don't see it until you're on the HUD, and now you have no other options because no one else can close in the next day or two. But I think there's also a lot of lenders that don't care that much. If you really think about it, there's not much risk to a lender if you don't close. They don't lose any money, right? Nothing's been transacted. Whereas you, as the investor, you might lose your earnest money, and I think more importantly, your reputation. And so your ability to get deals from the same wholesaler or realtor really goes down. It's much more risky for you, and a lot of lenders just don't realize or care about that.
For
Um,
sure. Yeah, I actually got a call earlier this week that was like that, they were using one of the online, hardmoneylending.com or something type company. And I think it was a few days before closing, they immediately changed their terms and they were actually going to lend like half of what they said they were going to. And so, that kind of killed the deal. So, how can an investor protect themselves then? Or like what questions should they be asking to make sure that they're not having that kind of experience?
it takes a lot of experience to know what to ask, right? I think the other thing I didn't mention is that some lenders are big enough where they're a big company and they hire a whole bunch of people, and the person that you're interacting with, that front person, that rep, they're new to the game. They don't really know much about investing or even lending, right? And their job is just to pull people in and get leads and say, hey, yeah, we can do the loan. And that's, essentially just reel you in. A good lender rep knows how to disqualify deals. Like they ask the right questions. Like when I look at something, my first instinct is how do I kill this deal? And if I can't kill it, then we move on, right? Because there's things that you can ask up front to know where the issues can lie. One example is if you're in a wholesale transaction, you need to ask, will you finance the wholesale fee?
Right.
Right? Because not all lenders will do that. Some lenders will not finance any of it. Most lenders will finance a certain percentage of it, usually about 10% of the purchase price. Kind of skipping ahead, so this is kind of one of the headaches of between investing in state and out of state, right? Because like in Seattle, you're buying something for $200,000 and you might have a $20,000 wholesale fee, and that's fine, right? It's pretty small relative to it. I had a deal in I think Kentucky where it was like a $20,000 purchase price and like a $20,000 wholesale fee,
Wow.
and I had to pay for most of that out of pocket because the lenders just their rules, right?
Mm.
So it really affects your terms and just down payment overall. Other things, just really inquire about their closing speeds and what exactly is needed. Ask about the docs up front. Ask why they need the docs that they need, right? So if they're asking for bank statements, ask them what are you looking for in the bank statements. Ask them if they source the money. So basically, if you might have a kind of a private loan with a family or another investor that was deposited last month, and some lenders don't like that. You would think hard money doesn't care, and this kind of goes into the difference between kind of the local hard money guys versus the national ones. National ones tend to be more strict in their underwriting. It's going to be closer to a bank underwriting, but not that bad. And national lenders tend to take longer. They don't know the area as much, so they overcompensate by doing more underwriting, more appraisals and whatnot. I actually wanted to write like a blog of like all these questions that you should ask a lender. When I talk to a new lender, it takes me about an hour to interview them. Only the first 5 or 10 minutes are actually about rates and points.
Sure.
The rest is just like, okay, I'm trying to poke holes into their underwriting on ways the deal can die.
Right. Actually, Gabriel had a really good question here. Is there a preference on the lender's location versus property location and closing? So, like he had an issue where a Florida bank didn't know the King County rules. It sounds like, at least what I'm gathering, and in my experience, is that there's actually a little bit more risk in working with a lender that's in a completely different state. And that's just been my experience from the feedback that I've gotten from other investors and kind of my research. Would you agree with that, or do you think that there should be a preference on the lender's location?
Local lenders have much more flexibility, and they're able to close faster, and there's more assurance of closing. That's going to be true regardless. What I usually do is find ways to mitigate that, or know them well enough where again I can kill a deal up front if I need to. I do chase rates and terms. I like to use cheaper lenders, right? And I've done enough where I can kind of mitigate some of the risk. But the other thing is that as an investor that invests in multiple other states, right? Sometimes having a lender that you can take with you no matter where you go is also valuable too, versus having to kind of like try and test new lenders in every different market.
So let's switch gears. And so when you are pre-approving a investor for hard money, what does that process look like?
What I usually do is just ask a series of questions, and I try to ask the minimal amount of information I need to qualify both the deal and the borrower, right? So the deal, I kind of look at it from my own investor's standpoint. Like I put on my investor hat and say, does this deal make sense? And I can tell you like almost half the time it doesn't.
Mm-hmm.
At least, especially if they're going to try to flip it. I tell them, you don't have enough equity here. You don't have enough room for things to go wrong, and I don't think you should take on this deal. there's always that coveted 70% rule from, from bigger pockets. And I think that, I think people complain how hard it is to achieve, but I think it's a good rule,
Yep.
right? And that rule is essentially like your purchase and rehab price is no more than 70% of the ARV, because that leaves enough margin for you to do the deal and to handle when things go wrong. Obviously, of course, try to do better if you can, but that's kind of a general rule of thumb. So I look at the deal. I look at the type of financing it is as well. Obviously, if it's like a fix and flip of a 1 to 4 unit is different than a fix and flip of five. And anytime you get to 5+, the loan just gets more complex, right?
Yep.
Because you're dealing with commercial properties.
Yep.
Or if it's a heavy rehab, new construction, it all plays a factor. So I look at the numbers for the most part of the deal. And then from the borrower side, I think the thing that kills the deal the most, and this is the thing I can tell you from bigger pockets, I'm going to blame it on Brandon on his book of like low and no money down investing. But everyone seems to think that you can get financing at 100% and no points.
Right.
The truth is that anytime you're doing something that has value add or needs some work, essentially, it's cash is king. I mean, you need liquidity because things go wrong and you need to be able to handle it, right? And lenders look for that. They look for usually enough money in the bank to fund the closing and also to handle monthly payments and also to have extra reserves for budget overruns. So they'll look for some of those things. So usually liquidity is what kills the deal the fastest, right? Number two is most lenders have some kind of minimum credit score requirement. I mean, some lenders, they price their terms based on the credit in different tiers, like maybe every 20-point bucket or something. But most lenders you just have a minimum, and as long as you meet it, you can get the loan. And then of course there's the rehab itself. This is kind of why I like to use a lender, not necessarily a hard money lender, but a lender in general when I invest out of state, right? Because a lot of these things that a lender makes you do, like an appraisal or sometimes a budget inspection, it's something that you should do as well. I mean, I think you should always do those things, right? A lender essentially watches your back. If the lender's not going to fund a deal, it says something about the deal.
Sure.
And you should go back and run your analysis. Because I've had lenders where sometimes they vet my GCs for me if it's a heavy construction. Sometimes they even do a rent market analysis or even just other things that you don't think about, right? And they'll ask you, hey, did you get flood insurance? Did you get this kind of insurance? Did you know this is a danger zone for this and that? And so it's like having a second set of eyes, like a partner that watches out for your back. The other nice thing is that after you close on the deal, a lot of people complain about, like draw inspections and whatnot. I really like it when I invest out of state because it's, again, another third party taking pictures and telling me how much progress has been made on my project. And that's like a free service. I mean, you pay for it, but it's an added bonus of using a lender.
And do you suggest that an investor kind of get pre-approved or at least start a file before searching for properties, or would you rather see it once they have a deal?
I think if it's your first time using hard money and you don't know what to expect, definitely get pre-approved and talk to some lenders and see what their expectations are. People always say, should you get the financing first or should you get the deal first, right? And they say that if it's a good enough deal, then you'll always be able to get financing for it. Mm-hmm. But when you're first starting out, you don't really know what a good deal is. And so that's why that's important. I have confidence in taking a deal when I know I have my lenders on, and like watching my back and pre-approved and whatnot. Some lenders don't like to do pre-approvals. Some lenders are like, they tell me they have a lot of volume. It takes a lot of resources to pre-approve a client. They'd rather just not deal with it and just look at it when the deal comes in.
Yeah.
So it depends as well.
I think, my advice to investors has always been, if you're entering into a market that is extremely competitive, where you're going to be competing with other cash buyers or buyers that are using hard money, is to at least initiate the conversation in the beginning with a couple hard money lender companies, so that also when you're doing your deal analysis, you can factor those numbers in. But sometimes, like I see, an investor found a deal and they're super excited about it and there's multiple offers, and then they're kind of scrambling to get a proof of funds or an approval letter from hard money lender. And so I think that it kind of depends on the market. At least that's been my advice, is, again, if you're entering into a market, like if you're, looking to do value add multifamily in Seattle, I think you're going to pretty much have to have cash or be willing to pay well above what other buyers would pay. So that's, always been kind of my advice, but I think it's very depending on the area and situation.
Whether or not they actually do give you an actual formal pre-approval, you should talk to a lender and have some idea of what the terms will be before taking on a deal in a certain area, especially if you're coming from the Seattle environment and you're used to lenders here, and there's a lot of differences in what lenders do in Seattle and what lenders do in other places.
Sure.
Right? I don't think people realize that until they go out, but like things like financing at the auction, that's not normal. I mean, it's normal
Right.
here in Seattle. You see so many people doing it, but in other places, it's not normal. Like 2 or 3 day closings, it's really hard to do that in most places. And the amount of, or I guess, lack of underwriting that sometimes the lenders do here is also not normal too. And so you have to have a mindset shift when you go out of state to other markets and say, hey, I need to understand that people generally do things differently.
For sure. Let's talk about some general kind of rates and terms. Again, it's all property dependent, area dependent. But for the people that have never, again, really heard of hard money loans or aren't really familiar with how it works, can you walk us through like what you're seeing as kind of some general terms for points, term, and interest rate?
So for brand new investors, obviously you're going to be in the higher end because I think experience drives terms the most out of any other factor. I mean, obviously in our area, I think 12 and 3 was the standard, 12% and 3 points for like 6 months was the standard for a while. That's changing. I mean, that's changing rapidly right now. It's not hard to find rates in the 9s and 10s, even for a brand new investor. And then like 2 points for like a 1 year loan. That's the competitive new rate that's coming to town. In other markets, what really drives a lot of these lenders' decisions as well is the loan size, right? And that's something that you don't really think about in Seattle. I mean, you never hear people talk about minimum loan amount at all in Seattle,
Right.
right? And most lenders have one. Most lenders, it's going to be at least $100,000. Once you get below that, it basically cuts out half the lenders that you have.
Yep.
And then the next tier is 75,000, and the next tier will be 50,000. Under 50,000, it's possible, but it's very hard to get a loan. Most lenders, I mean, if you think about it, a lender, they have fixed costs, right? It takes them the same amount of time to process a $50,000 loan versus a $500,000 loan. But they make so much less money doing it, so they don't even want to deal with it. Because of that fixed cost, most lenders don't really charge points under $100,000. They start charging just a fixed fee
Transactional
to do
costs.
those loans.
Right.
Yeah. For these smaller loans, I think the minimum any lender wants to make is like at least $3,000 a loan. Let's just use the $3,000 and let's assume that's the fees and the points, right? Some lenders charge, and by the way, this is something you should always ask a lender, what are your fees?
Right.
Because everyone always advertises their rates and their points, but no one ever talks about the fees. I've seen fees as high as $5,000 for a loan.
Right.
In other places, they tack on something called an attorney fee for $2,000 or something like that. If it's $100,000 loan, right, and it's $3,000 for the total fees, both points and fees, that's 3%. At $50,000, that becomes 6%. As you get lower, the loans start becoming more and more expensive and maybe not even worth it to do it. So that's something to keep in mind. So lenders they charge points and they charge fees, and they also have a minimum that they have to collect as well. So whichever is higher. And for new investors, I would say around 10%, 10 to 12 maybe, depending on the area, depending how many lending options you have, and then 2 to 3 points.
Sure.
It's pretty normal. And down payment is, I would say, 20% is a safe number, conservative number. You might be able to get it down to 10% in certain areas, even for a brand new investor. And keep in mind too, when I say down payment, I don't mean that that's all your money you need to have in the bank, right? Because usually cash to close is a little bit higher than down payment. There's closing costs, there's extra fees, there's again, lender points and fees that you pay up front. And then lenders also want to make sure you have reserves in the bank for everything else. So whatever I say is a down payment, you should probably add another 10% for that in the bank account.
Sure.
So that's for newer investors. For experienced investors, it's kind of like all over the place, right? Every lender does things a little bit differently. Some lenders have experienced tiers, some lenders have credit tiers. Some lenders have more down payment, you get cheaper rates. I've seen for experienced investors rates as low as like 7%.
Sure.
Usually it's not worth it to get there because you're putting down like 30-40% down.
Right.
And you have to get a really good deal where you're getting equity both upfront and at the end.
Right.
Points are usually driven by the loan size, what I can tell. In Seattle, I've seen it as low as like 3/4 of a point for a hard money loan, which is insane. Right. But normally I would say a safe bet is every lender wants to make at least 2 points.
Yeah, that's kind of what I've seen too. I think, in certain markets, I'm seeing a lot of 2 and 12 or 2 and 10 or, things like that. And for those, I should point out, for those that don't know what we mean when we say point, that is an origination point or a percentage based on the loan amount. So that $100,000 loan is a $1,000 point. So 2 points would be $2,000. So for those that aren't familiar with that. So now that we've kind of, I think, really covered all of the specifics on these hard money loans, so let's talk about strategy. I think that's really the most important, part of all of this is, what, especially the BRRRR strategy, right? I mean, that's kind of the hot topic, or has been the hot topic for, gosh, at least since I've ever been investing. So, Ilya, I'll kind of tell you what my strategy is, and then you can kind of also, chime in as well. So, the structure that I've always used is for one, first and foremost, get pre-approved for the refinance and determine, are you going to go a, 1 to 4 unit property conventional Fannie Freddie product? Or are you going to try to get a portfolio loan from a local bank? But for this, scenario, let's just say it's a, 1 to 4 unit conventional refinance. So the biggest thing I think where people maybe they hear that, but then they miss out on the difference between a rate and term refinance and a cash out refinance. That's at least where I've seen the most kind of mucky waters is, how those work. So, the cash out refinance typically has a seasoning requirement if you're wanting to use the new appraised value. And I would say the majority, probably 9.9 times out of 10, we are wanting to use the new appraised value after our value add strategy has been implemented. So for those, like if you guys see people on BRRRR, talking about it, I think a lot of times people are talking about cash out refinance. Just know that you're going to have to be in that hard money loan on title for 6 months in order to get any kind of cash back into your pocket. And oftentimes it's at like 70 LTV. So as you guys are talking to, again, first the mortgage brokers, you want to make sure that it is really clear if you're going for the cash out refinance or the rate and term. And the difference, so I've always done rate and term. And the reason why I want to go for a rate and term refinance is because I don't want to wait for that 6 month seasoning. And I want to use the maximum LTV at 75% for a multifamily property or 80% for a single family. Now, in order to do that, though, you have to be prepared to either negotiate a 100% hard money loan, or that you're not going to get your own capital, your down payment back. Anything to add on that, Lee, as I'm just rambling on here?
No, I completely agree. By the way, this is where I first met Jennifer. I'm like, this gal is smart and knows what she's doing. I saw one of her posts on BRRRR. I'm like, huh, what do you need to get this 100% financing, right? And there's many different ways. I think as long as most people understand that a rate and term finance means that you're paying off an existing loan. Yes. And that's why the 100% financing works, right? It's basically your upfront financing will set the way for your takeout financing. What if you got 125% financing and got rate and term refinance? That works too, right? Yeah. I don't like to wait 6 months, mainly because then that puts me into a hard money loan longer than I need to be, right? Mm-hmm. And by the way, I mean, you don't have to use hard money to do BRRRRs. You can do cash, you can do private money, you can do many different things, but hard money seems to be the general standard. It also depends how much equity you have in the deal, right? Because if you're buying things following like the 80% rule, generally you can just get a hard money loan at like 75% of ARV and just do a rate and term refi, because a cash out refi doesn't get you any additional money out.
For sure. Yeah, I think that makes a lot of sense. And at that point too, and I tell people, like, people get really excited about the idea that they could, which is very true, that they can buy rentals and have almost zero into the deal. But you have to know really how to set it up, and you have to have some money. So no hard money lender that I know of would ever do 100% loan with no collateral. So when we're talking about collateral, so a lot of times what I've done is I've done either a cash deposit with the hard money lender. So for just round numbers, $100,000 hard money loan, if the lender wanted a 20% down payment, instead of me bringing that 20% to escrow to close, they record the $100,000 mortgage, and then I write them a personal check or something like that, or wire them the funds for $20,000. And then that gets released once their loan gets reconveyed or refinanced, through that process. So of course, I still have to have that $20,000. I think, again, sometimes people think, oh, well, 100% financing, if I have $5,000 in the bank, that's okay. Well, that's not. So you definitely have to have some money to work with. And then you'll, of course, get it back and then you can roll it into the next property. But first and foremost, can't do it if you only have a couple grand. So that's super important. But yeah, that's something that's super confused. I see Albert is chiming in here on some of the details about the rate and term versus the cash out. But again, I would get that crystal clear in the beginning with whichever lender is going to do the refinance or the permanent financing, that we call it, so that you know that going up front. And then let's say, you decide, yeah, I do want to go for the rate and term refinance approach. Then the next question is to the hard money lender, what would you require in order to do 100% of purchase price loan for me? Do you want a 30% cash deposit? Do you want a second on another house that I own free and clear? Do you want more points? What would be their requirement? And some lenders may say, no, they don't want to do that. But I think, you really, again, need to know first what you're getting into, what questions to ask, who to ask them of, and be really clear on your strategy going forward. So that's, I kind of became a master of that. I like to, play the game of low or minimal down investing. But I had to first become a student of how it works and make sure that I associated myself with the right people who could implement that strategy with me on the debt side, and that I was very, very clear on the rules. So that's, kind of what we're really hammering in here.
I would add that, I usually see it being done, like 100% financing or with second liens. The caveat is that, I think if you ask any conventional lender, the second lien has to be recorded at the same time as the first, not after,
Yes.
in order to account for rate and term refi. And your hard money lender has to also allow for second liens. Most national hard money lenders don't do that, just FYI. The other kind of unique strategy is that, if you have the cash to buy it just in pure cash, but you want to get a rate and term refi at the highest value that you can get, you can have another company, you can do loans for yourself. And then just do a rate and term refi out of that, right? Or you can do a combination